in China should investors get into, and which ones should they stay away from as more policy reforms are announced at the NPC?
Well, certainly the policy announcements at the NPC, what we think we think is going to be supported over the next 5 years by policy, again, is this transformation of the China economy, and also something that we previously called the 7 strategic industries. And we do feel that at the moment the market is definitely supporting those themes, and those are things like consumer stocks, retail, technology, so that China moves up the value chain, things like agricultural stocks, and any other stock where we see the transformation into the new type of economy in China, and also those which are linked to environmental protection. So at the moment, those are the stocks which definitely have the wind behind them. When you look at the rest of the market, a number of sectors, the old big sectors in the index, for example, such as energy or financials, they may suffer some policy headwinds going forwards, but we do remain invested into those areas, and we just have to be more selective in that case, because these are still major areas in the economy and in the stock market capitalization. So we don't believe in completely excluding those stocks from our universe either.
NPC's press briefings happens today. Markets are focusing on guidelines or hints of policy tightening. What are your thoughts? Are you expecting any policy changes?
We're not expecting any major changes in policy at this stage. We do feel that, yes, there is a risk of monetary tightening. This is not so much in terms of a cyclical phenomenon, but also because there is a very strong focus at the moment on the property sector, and things are getting out of control there. And we do see that there has been a real pickup in activity in the property sector, and it's very important for the authorities to get this one right. So we're quite open about what we might see from the policy announcements going forwards. But we do feel that stability is the key here, keeping inflation under control, but also making sure that growth remains at a steady level of between 7.5% and 8%.
Some say positive earnings will underpin the rally in Asian equities. Do you agree? Why or why not?
Yes, well, there is, as we've always seen, a very strong relationship between the earnings cycle in Asia, in emerging markets in general, and that of the stock market cycle. And sometimes it's a little bit difficult for us to distinguish between the cause and effect of that cycle. The conditions that we think could lead to better earnings in Asia going forwards this year, things like growth being strong, continue to be strong in China and India, Indonesia, Southeast Asia, everything going very well there. The global environment also helping some of the exporting countries like Korea, Taiwan. So we do think that top-line growth can increase, and also reduced margin pressure, especially with rates coming down, maybe commodities as well, price weakening. The pressure on margins may be reduced. So we could see revisions in the earnings cycle. We've certainly seen a stabilization of that cycle. And a lot of this will be already anticipated by some stock market investors, not all, but some stock market investors. And therefore, we should see a strong link this year between the earnings revision cycle and that of the stock market. And for the time being, things are really just stable, which is why you've seen more volatility in the market itself, which is also, as well, largely influenced by global factors.